Welcome to our first video of 2024. This video is going to cover the most asked question us realtors get asked at the beginning of every year. What's the real estate market going to do this year? Hi, it's Brooks Mars, MMG Real Estate Advisors here with our 2024 Orange County Real Estate Market Forecast. If you find the information in this video helpful, be sure to hit that like button, and if you want to see more, hit that subscribe so you never miss out. So before we jump into our 2024 forecast, let's go over what happened in 2023. In 2023, the Orange County housing market faced challenges with historically low inventory levels, starting the year with only 2,431 homes, the second lowest since 2004. The lack of available homes has been a persistent issue since the pandemic began 4 years ago. Despite a brief rise in inventory in mid-January, reaching 2,536 homes, it dropped to 2,053 homes by the end of April. The peak in November at 2,496 homes was still 58% below the 3-year average before COVID. Towards the end of 2023, the available homes decreased to an unprecedented low of 1,862 homes. The trend of low inventory is attributed to homeowners choosing to hunker down amid rising mortgage rates. Now for demand. The demand for homes followed a seasonal pattern, with the spring market being the strongest and the holiday market being the weakest. Affordability challenges due to higher mortgage rates impacted demand, resulting in a 31% decrease compared to 2022 and a 35% decrease compared to the 3-year average before COVID. Despite the muted demand, housing remained active with a peak of 1,706 pending sales in April, down 25% from the previous year. Towards the end of 2023, demand dropped to 1,053 pending sales, the lowest year-ending reading since tracking began in 2004. Now the luxury market. The luxury real estate market saw a record-setting year in 2021, but experienced a slowdown in 2023. Despite being the third strongest year since 2004, luxury sales above $2 million were off by 19% compared to the previous year, and 28% compared to 2021. The expected market time for luxury homes increased from 45 days in February to 168 days at the start of December, reflecting a significant deceleration from the fast-paced pandemic market. Now for the expected market time in Orange County in 2023. The expected market time for the overall Orange County housing market started the year at 82 days, similar to pre-pandemic levels. Then it dropped to an extremely competitive 37 days by the end of April, but increased as mortgage rates rose, reaching 60 days in November. With rates dropping below 7% at the end of the year, the expected market time decreased to 53 days by the year's end, indicating a more favorable market for sellers compared to 2022. So what's the housing market forecast for 2024? Well, in 2022, home values in Orange County reached a record peak in May, but subsequently dropped for 7 consecutive months until December. Despite this, inventory of available homes decreased at the beginning of the year as mortgage rates declined. Home affordability improved slightly due to lower inventory levels, especially in lower price ranges. Throughout 2023, home values rebounded, surpassing the May 2022 peak. The Federal Reserve raised the federal funds rate to 5.5% in 2023, but with inflation easing and the economy showing signs of potential cooling, the Fed hints at future rate cuts. The forecast for 2024 presents 3 scenarios based on when the economy is expected to cool. Scenario number 1, economy cools during the spring, about a 50% chance. Interest rates, mortgage rates may drop to 6 to 6.5%, falling below 5% in the second half of the year. Active inventory, despite a low start, the inventory crisis continues, reaching a peak of 2,500 homes in the summer. Demand, buyer demand increases during the spring market, resulting in multiple offers and bidding wars. Now closed sales, anticipated to increase by 16 to 23% compared to 2022, totaling around 24,000. Home values, expected to rise between 4 and 7% for the year. Scenario number 2, economy cools during the summer, 45% chance. Interest rates, mortgage rates may start between 6.5% to 7.5%, dropping to below 5% by the end of the year. Active inventory, similar to scenario 1, the inventory crisis persists, reaching a peak of 3,000 homes in the summer. Demand, buyer demand picks up during the summer market due to lower rates, resulting in increased affordability. Closed sales, expected to increase by 12 to 18% compared to 2022, totaling around 23,000. Home values, expected to rise between 1 to 4% this year. Scenario number 3, economy cools during the fall, 5% chance. Interest rates, mortgage rates may start between 6.5% to 7.5%, dropping to 6 to 6.5% in the autumn. Active inventory, the inventory crisis continues, reaching a peak of 3,500 homes in the summer. Demand, buyer demand picks up during the autumn market with lower rates, leading to multiple offers and bidding wars. Closed sales, expected to increase by 10 to 14% compared to 2022, totaling around 22,400 homes. Home values expected to drop between 0 to 3% for the year. The overall housing market will follow the typical cycle, with the spring being the strongest in demand. Luxury housing will experience longer market times, and the spring market will be the strongest for luxury, becoming sluggish in the second half of the year. Foreclosures and short sales are not expected to surge, as distressed properties remain below pre-pandemic levels. In summary, the housing market is expected to heat up in 2024 as the economy cools, with varying degrees of impact depending on the timing of the economic downturn. Now, I'm going to pass it to Chris, and he's going to drill down on the economy and supply and demand.
Thanks, Brooks. Those stats really help paint a picture. So what's the carryover from 2023, and how is it expected to impact the economy and ultimately the supply and demand of housing in Orange County? Clearly, mortgage rates can influence supply and demand a little or a lot, depending upon how aggressively rates move up or down. Now, the great example an economist shared was when mortgage rates went from 7 to 8% in 2023, and approximately 5 million prospective U.S. buyers left the market because they could no longer afford to purchase. Now, conversely, in December of 2023, when rates came back down to 7%, those 5 million borrowers could re-enter the market. But did they? Keep in mind, some of these buyers would need to enter the market first as a home seller and then become a buyer. The expectation is we should see lower rates in 2024 as the lag effect from the Fed's aggressive actions since 2022 to reduce inflation pressures continue to work their way through the economy. When the Fed changed their outlook and language towards higher interest rates going forward after their December meeting and signaling potentially 3 rate cuts in 2024, we saw lower mortgage rates immediately. Even the equity markets responded favorably, with the Dow Jones hitting a record high last month. The last thing the Fed wants is to undo any progress they have made, so they walk back an immediate rate cut in 2024. That said, the economic data will ultimately dictate when a rate cut is prudent. Now, Mark Zandi, chief economist at Moody's Analytics, published a great report on this in January of 2023. Yes, a year ago. That the economy would experience a slow session rather than a full-blown recession, which would have a bigger impact on the real estate market. It was a great read. Since that report and others were published, a growing consensus among economists has supported this opinion. Yes, we take the time to read several reports and review the economic data every month to keep our clients informed. As we said back in 2023, in order for supply to begin to expand, we must see mortgage rates stabilize near 6.5% and trend lower on favorable economic data. The reality is the spread is still too large between today's rates and the lower rates of 3 to 5% that the majority of homeowners in California and the US secured much earlier. As this spread shrinks, more inventory will hit the market. The same goes for a measured demand based on affordability. Now, this chart really puts into perspective the affordability challenges many face. This example assumes a $4,000 a month principal and interest payment, which is realistic for Orange County. With mortgage rates from 3.25% to 8%. Moving from an $800,000 home purchased in late 2020 could mean that move-up price now is $1.35 million. Easily. So lower interest rates are essential for many to stay local unless some sellers are relocating to lower cost markets. It's officially 2024, and this year has started with less than 1,700 homes on the market. Now, this is the second lowest start in 20 years. So it will be important to see what the inventory looks like in February after more economic data is released and the Fed's first meeting of 2024 at the end of January. Keep in mind, the SoCal new listing inventory has been in the negative since 2020 when compared from 2017 to 2019, as this chart shows. Yes, that number's right. 39% or 100,456 less homes on the market from January 2023 through November. We'll continue to monitor the reports and economic numbers, so be sure to watch our monthly market reports. A quick word for the doom and gloomers on social media. Enough already. Even Chicken Little finally accepted that the sky wasn't falling. You have cost too many homebuyers opportunities in the market. For years, you have felt no shame profiting off your fear-mongering posts on social media that simply didn't provide a balanced reporting of the data. Well, some people have asked why we never discuss commercial real estate. It's because we don't specialize in that sector, so we don't go there. One thing I will say, it's important to understand that commercial real estate is not financed with 30-year fixed-rate mortgages like residential real estate can be. Their maturity dates are much shorter, which require new financing. Their increased borrowing costs today have impacted their evaluations negatively and have caused some real challenges obtaining new financing. The PIMCO Fund last year walked away from 20 hotels carrying $240 million in debt. I'll leave it at that. Now, some quick facts about the housing stock. 1, did you know that between 40 and 42% of US citizens own their homes free and clear? 2, the percentage of outstanding mortgages by interest rate in California are 85% have interest rates of 5% or lower, 69% have interest rates of 4% or lower, and 30% have mortgage rates of 3% or lower. 3, home equity in the US is at historical levels. 4, since the passing of the Dodd-Frank Act in 2010 that eliminated risky lending practices that led to the Great Recession of 2007, has vastly improved the quality of borrowers for well over a decade. Now, if you have any questions about anything said in this video or something you read online, feel free to drop us a comment, give us a call, text, or shoot us an email. We're here to help you navigate the home buying or home selling process and be a trusted resource you can rely on. If you feel there is someone you know that can benefit from this information, give it a share. And until next time, Brooks and I want to wish you good health and good fortune in 2024.